Hello and welcome back to my channel of Learning Made Easy with Rohit. This is Financial Accounting Part 6, and in this presentation we will be discussing accounts receivables. In this presentation, we will learn how to account for accounts receivables, how to estimate our uncollectible accounts receivables, and how to account for those uncollectible accounts receivables and the payments. Now, what is accounts receivables? Accounts receivables is an asset. To be more specific, it is a current asset. And if you remember the definition of a current asset, these are those assets which you plan to convert into cash in 1 year or less. Accounts receivable is the third most liquid asset, right after cash and marketable securities. You can also term marketable securities as short-term investments. They are very, very highly liquid, means you can buy and sell those investments in the open market in a very, very short period of time. Okay, so they can be converted into cash very, very quickly. And accounts receivables comes right after your marketable securities. Now, accounts receivables, it is the amount that your customers owe you. So in other words, it is collectible from customers. Okay. And why will they owe you anything? Well, the simple reason is because you sold them your products or you performed any kind of services for them. Okay. So you sell your products or you perform service for somebody and they don't pay you cash at that time. They will pay you at a later date. And in the most simplest terms, and that's exactly what accounts receivables is. Okay, we will abbreviate accounts receivables as AR. Okay, in your general ledger, okay, so imagine you have a business, okay, and you have hundreds of customers. And out of those customers, maybe let us say 50 customers are the ones who have a contract with you. So if you sell them your goods or you perform any services for them, they don't pay you cash at that time. They have a contract that they will pay you in about 1 month. So what happens is after you provide them the service or you sell them a product, you will send them an invoice and they will pay you in about 30 days from the date of sale. In your general ledger, okay, and remember, ledger is a collection of all your T accounts. In your general ledger, you will see a condensed accounts receivable balance. So what that will do is it will add all the balances for all your customers and it will present you as one line item. The subsidiary ledgers, they will show you exactly how much money each of those customers owe you. So in general ledger, you will see one line item that is your condensed amount. And in your subsidiary ledgers, you will see individual accounts of your customers. Something like this. Okay, so imagine you have three customers. Okay, in this example, customer A, B, and C. Customer A owes you 5,000, customer B owes you 1,000, and customer C owes you 3,000. Okay, these are your subsidiary ledgers because it's showing the amounts for each account. And in your general ledger, the general ledger is going to add all of these accounts and show you as one account. Okay, now when we sell on credit, there are some guidelines that we have to follow. Okay, and then we also have to understand some benefits and risks, and we will talk about all of them. Okay, so what is the benefit? Well, the benefit is you will have increase in sales. Okay, you will have more customers who will basically either come and buy your goods or services, or they will invite you for performing a service for them. Okay, so you will have an increase in sales. And what is one of the cost or the risk is that maybe some of them are not going to pay you. Okay, it could happen. Let's be realistic. Not everybody will be able to pay the money, okay, because of different reasons. Now, we have to be very careful in business who to give credit to and who not to. And for that, what we do is we run a credit check. In the simplest of terms, credit check is basically checking references. Okay, so what they will do is the accountant is going to call some references, or they will gonna call the bank and make sure that this particular customer who is requesting credit is in good standing. Okay, so that also includes, calling other businesses to make sure that they pay on time. And then obviously you will check their credit history. Okay, just to make sure that this particular customer is safe, we can extend the credit, and um, you will get paid. And what do we do? Once we make the sale or once you provide the service, you have to pursue the collection. Means you have to be on top of your accounts receivables. When it's time to pay or when it's time to send the invoice, make sure that somebody is on top of your accounts receivables, or your payments are going to get late. Okay, you got to make sure that you're sending your invoices on time. You're calling to follow up. Okay, sending emails. Okay, and when you get the check, make sure you enter the check and deposit it in the bank. Okay, this will also help you to know your customers better. Okay, why? Because you will be keeping a very, very close eye on their paying habits. Okay, because the thing is, if you see a customer who is habitually delaying payments, that should be a red flag for you. Okay, and when there is a red flag, then obviously what you need to consider is to either reduce the amount of credit that you are providing this customer, or totally stop giving credit for future businesses. Okay, so coming back, what is the benefit? Okay, see, you got to understand there are different kind of business. Okay, in small businesses, for example, when you're going and buying groceries, it's a cash-based business. People come, they buy their groceries, and they will pay you cash. But in a bigger business, okay, you are selling goods or performing services worth thousands of dollars. Not everybody will be able to pay you at that right very moment. There will be customers who will require time for payment because, as I said, not everybody carries cash. Okay, and let's think of even the grocery business. Okay, when you're buying groceries for your home, so you're carrying cash or you're gonna pay by a credit card. But let us say, for example, let us say you are, you have a friend, okay, and the friend owns a restaurant, and there is a relationship between your business and your friend's business. Okay, and obviously you have a grocery store. Okay, your friend is owner of a restaurant and buys groceries or raw materials from you. Okay, again, it's a good relationship we have between these two businesses. So obviously, when somebody comes to buy stuff, groceries for their family, they're buying in a very, very small quantity. But when you have a business coming to buy raw materials from you, the quantity is much higher. Okay, quantity is much higher. And the frequency means how many times they come and buy from you will also be more than a simple household. And obviously, that restaurant is not going to be able to pay you cash all the time. Okay, because the amount of the groceries they are buying from you is a lot. Like it's much more than somebody who is buying for their home. So what you will do is obviously you will extend credit, meaning that okay, in a certain month there will be purchases, and then you're going to send an invoice and you will give about 30 days or something, whatever your contract is, for the other person to come and pay you. So there is a benefit. If you are not extending credit, you would lose this customer, because obviously this customer cannot pay you cash. This customer, who is also a business, will go to somebody else. But because you are extending credit, it's a benefit for you, because now you are attracting people who cannot pay cash for every business transaction. So your sales and your profits will increase. But then there are costs. Costs, like sometimes they might not be able to pay their bills, or they will be able to pay their bills, but they will delay the payments. This particular cost is called uncollectible account expense. Okay, in accounting, this cost of doing business, especially when you are extending credit to somebody, is called uncollectible account expense, or you can also call it a doubtful account expense or a bad debt expense. Okay, whatever you decide to call, they're all the same thing. Okay, now let's talk about that cost. Okay, so you have some customers who owe you money. Okay, but as a manager, it's your job to estimate how much will you be able to collect and how much you will not be able to collect. Okay, you have to estimate. And how do you estimate? You estimate based on your experience. Obviously, if it's a new business, you will not have that experience. But if the business has been running for quite some time, you will know, out of all these customers, what percent of amount might be uncollectible. Please mark my words. Okay, I'm talking about your estimation amount that might be uncollectible. Okay, because you have to report it in the same period. Okay, if you make a sale in January, you have to report how much of that sale you will not be able to collect. And any money that you're not able to collect is basically your cost of providing credit to those customers. Okay, so with your experience, you will estimate how much money you will not be able to collect. In other words, you are estimating your bad debt expense. That's what you're estimating. Okay, estimating your bad debt expense, the money that you will not be able to collect. So what you will do, okay, in accounting, when we do these transactions, there are certain things that we will have to take care of. We will talk about that in the Excel very shortly. But please remember, okay, so we are talking about an expense, which is your bad debt expense or uncollectible expense, whatever you decide to call it. And we are talking about an account. This account is called allowance for uncollectible accounts. So our primary focus is number one, bad debt expense account. Number second is our allowance for uncollectible accounts account. And what is this allowance account? Well, in the simplest terms, this is your estimate. It is a provision. Okay, so it's a provision that you open that say, okay, well, I think that in this particular month or this period, I will not be able to collect $5,000. Okay, and then you give yourself that provision, and that provision is your allowance account. Okay, allowance account is going to show you how much accounts receivables you will not be able to collect, which you have estimated as bad debts. It will give a balance for all the amount that you think or you estimate you will not be able to collect. Now, what is allowance account? It's basically a contra asset account. Contra. What is contra? Contra is something that contradicts. Contra is something that goes against something. Now, this account is going against the balance of accounts receivables. Means it is basically telling you how much of this accounts receivables you will not be able to collect. So it's going against the accounts receivable amount. For example, your accounts receivables has $1,000 balance. Okay, and your allowance has $500 balance. What that tells you? It tells you that in any given time, you can safely estimate to collect $500. So $1,000 accounts receivable balance minus 500 allowance balance. The balance is 500 that you should be able to collect in your professional estimation. Okay, so this is your allowance method, and we will get into details when I do the Excel example with you. Net realizable value. Net value that you can realize, that you can collect, is your accounts receivable balance minus your allowance for uncollectible accounts balance. It gives you your net realizable value of accounts receivables. Okay, so please remember, for accounts receivables, if you ever see a question about calculating net realizable value, there is no need to get confused. All you take is your accounts receivable balance and subtract your allowance for uncollectible accounts balance, and you get your answer. Okay, now we will talk about estimating. Okay, how do we estimate? Because it's easy to say, okay, we are going to estimate, but how? Okay, there are different methods. In this particular presentation, we will talk about a method called aging of receivables. Aging of receivables. What is aging? Aging is how old is something. So aging of receivables, how old are these receivables? This approach is called balance sheet approach. Different reasons, okay? One of the reasons is when we are focusing on a balance sheet, we are focusing on the balance sheet accounts. And obviously, by now, you should know that accounts receivables is your current asset, and current asset is shown in the balance sheet. So that is one reason that it is called balance sheet approach, because you are dealing with accounts that you see on the balance sheet. And number second is that you focus on the most faithful and relevant representation. You need to be truthful. Okay, you need to be honest in reporting your numbers. If your account receivable balance is $100,000 and you know as a manager that in any certain year, $20,000 you will not be able to collect, then the net amount that you should be reporting is $80,000, not $100,000. Because those $20,000 might not be paid. So you have to be very faithful when you report numbers. And the reason is because your numbers are used by shareholders. They are used by banks when they give you loan. So obviously you have to be truthful. You cannot give them misleading information, because then that can, lead to many more different kind of problems that obviously is not part of this particular, presentation. We will talk about them later on, but you have to be truthful. Okay. So what this aging of receivables will do, it will see how old these receivable accounts are. It will focus on proper valuation of your accounts receivables. I'm sorry. It will focus on your proper valuation. And obviously, when you are valuing, you will go through individual account balances of your customers. You have to see who owes how much and how old this particular balance is. In most businesses, the report that shows you how old these accounts receivable balances are is called the aging report. It's also called AR aging or aging of accounts receivables. Again, they can call it anything they want. It means the same thing. It's showing you how old those balances are. Okay. And once you estimate how much money in your professional judgment might not be paid back, you will have to make sure that your allowance account shows exactly that balance. Okay, now what we will do is we will open our Excel. And what we will do is, when in the Excel, I'm going to show you how to estimate these bad debts, and then what do we do after once we estimate these bad debts. Okay, so imagine that this is your small aging report. Okay, you have two customers A and customer B. These are the amounts that your customers owe you. Okay, so customer A owes you $5,000, and this is just a very, very new amount within the last month. $3,000 this customer owes you from before 31 days. Okay, so this amount is old. Okay, so it goes from 31 days to 60 days ago. And then you have $2,500 that this customer owes you from even an older time period. Okay, 61 to 90 days before. And $2,000 over 90 days. Customer B, you have $8,000, which is a pretty new balance. Okay, again, within the last month. From 31 to 60, customer B owes you $5,000. 61 to 90 days old, customer B owes you $3,000. And thankfully, there is no balance over 90 days. So before I start into this calculation mode, okay, I want you to think for a minute. The balances that are the oldest are at the most riskiest time of payments, means that they are the riskiest of all the balances. The older a balance is, the higher the risk that that money is not going to be paid. Because if there was no risk, if there was no problem, the business would have paid you that money already. So if you see something that's over 90 days, well, why is customer A not paying you $2,000? Because that's a very, very old balance. There could be many different reasons. Maybe they don't agree with this amount. Maybe they say, well, you know what, this is we don't owe you $2,000. What are you talking about? This could happen for many different reasons. One of the reasons is you don't have proper documentation. You have the invoice, but you don't have any backup of that particular business. It could be a voucher, it could be a delivery receipt, it could be anything. You don't have those documents. So risky. Okay. Or it could be just that this business is not doing good and they have lost their ability to pay you. So long story short, the older a balance is, the more risky that balance is. There's a highest chance of that money not being paid. The newer a balance is, so for example, these balances of $5,000 and $8,000, they're very, very new. They are less risky. There is a very, very high chance that you will get these payments. So as a manager, what do? Based on your experience, you will denote the risk percentage. So you will say, well, based on my experience, the amount that is the newest, there is a 5% chance, or 5% of this amount is not going to get paid. So 5% out of the total amount is not going to get paid. Then you say, okay, let's look at the 31 to 60 days one. Okay, well, we have about $8,000 total. We think that 8% of this amount is not going to get paid. And then you take another step. You say, well, 61 to 90 days old balance. It could be that 10% of this amount might not get paid. And well, anything more than that is very, very high risk, obviously, right? 20% of $2,000 might not get paid because you know that there is a, either you don't have documentation or something is really, really wrong. So you are ready to give some kind of a big discount to your customer saying, well, okay, I don't have the proper documentation, but let's see, you have been our customer, we will give you a discount. Let's just, clarify this account balance, clear this account balance, and we will give you a discount. Okay, there's many things you can do or say, okay, when it comes to accounts receivables, okay, giving them discounts, okay, allowances, things like that. But we will get there, okay, when time comes. So let's first see how to calculate. So what first thing you're going to do is, so you will give them these percentages. Okay, so these are your percentages. Again, these are not set. This only depends on the management's professional experience, discretion, and experience or estimation. Okay, so let's see how much amount we will not be able to collect, which is the newest. So 5% of 13,000 will not be able to collect. Okay, and then we will just formulate this. Okay, the total amount in this period we have estimated is 2240. Means $2,240 might not ever be paid. Okay, and again, I'm saying this. There is no surety that this is not going to get paid. Maybe they will pay you everything, but this is just your estimation because you have to plan in advance. Okay, before something, before somebody coming and telling you, well, I'm not paying you, you must be prepared for taking that loss. Okay, so 2,240 might not come back. Okay, and now what we will do is we will just do an example. Okay, and this example is loosely based on this example, and we'll just talk about how do we make those accounting entries. Okay, so let's do some transactions here. Okay, so for example, on January 26th, your business provided service to somebody, to a customer, and you earned $5,000 on account. Again, going back to my last presentation. When we talk about on account, we mean that the payment was not in cash. The customer is going to pay you at a later date based on the kind of contract you have. Okay, so $5,000 you earn as service revenue. So your service revenue, $5,000 went up, credit. Okay, remember, revenue increases shareholders' equity. Shareholders' equity increases from the credit side. This means service revenue or any revenue will also be added to the credit side. So $5,000 service revenue, and at the same time, this person did not pay you cash. So now you will have to add this amount to this customer's accounts receivable account. So $5,000. You will see in these T accounts, okay, in these T accounts, you will see that in the accounts receivables account, you will have $5,000 debit because it's an asset. Assets are increased on the debit side, and the service revenue, $5,000 credit. Let's see what happens now. On February 1st, you or your management estimated that the bad debts for a certain period is 2,240. This means you are assuming that this amount might never come back or might never be paid. So now what you will do is you will have to report this as an expense. Why? Why do you report as an expense? The reason is because it is a cost for providing credit. If you did not provide credit and you are just doing, a cash business, then this would not have happened. You would have, received the cash payment. But because now you are providing credit, there is a cost. One of the costs is the risk of not being paid. So bad debt expense of 2,240. And you will see again corresponding entry to your T account. The bad debt expense went up on the debit side. And why debit? Well, you guessed it right. Because expenses reduce your new net income. Your net income, when it goes down, it will cause your shareholders' equity to go down. And a decrease in shareholders' equity is reported on your debit side. This means anything that makes shareholders' equity go down has to be recorded on debit. So that is the reason why you see bad debt expense, $2,240 debit. Now, at the same time, you have to report or record a provision. And now we will talk about the allowance for doubtful account. Okay. So this is, remember, a provision. This is a contra asset account. Means it works against your accounts receivable account. It's on the asset side of the balance sheet. It works the opposite way of an asset. It doesn't work like an asset. It works opposite an asset, but it is reported on the asset side of the balance sheet. So let's see what happens. So credit for uncollectible account. This is your allowance account for the same amount, 2,240. Now you will see that your allowance account has a credit balance. In other words, if somebody asks you, what is your net realizable value? Okay, what is your net realizable value? The answer is your accounts receivable balance minus the allowance for doubtful account balance. The net realizable value is $2,760. This is the amount that we think this particular customer is going to be able to pay us. Okay, this is your estimation. So net realizable value, the formula is your accounts receivable minus your allowance for doubtful accounts. Okay. Number 3, on February 28th, the customer called you and confirmed that this customer is not going to be able to pay $1,000. Now, going back to what happened before. This $2,240 is only your estimation. It's only your judgment. Remember I said it could be that you are absolutely right, or it could be that you're wrong. Maybe people will just end up paying you every single dollar of their balance, right? And this is just an estimation. And that's exactly sort of what happened. Is this customer said, well, I can pay you everything but $1,000. Could be any reason. Could be any reason. Maybe they don't have the backup, or maybe they don't agree with how much money you are charging them. It could be anything, right? So they will not be able to pay you $1,000. So this, now you are confirmed. Now you are confirmed that $1,000 is not coming back. So what do? The first thing you do is you have to use that allowance. You gave yourself a provision or allowance for $2,240. You have to use this balance now. Okay, you have to use this balance. So $1,000 allowance for doubtful accounts debit. So out of 2240, you took $1,000 away because that is your reserve. Okay, that is your allowance. You took $1,000 from your allowance. And now at the same time, you will reduce the accounts receivable balance of your customer. So $1,000 credit. Now please see, in your accounts receivable T account, you can see this customer owed us $5,000, but now the customer is not going to pay $1,000 because of whatever reason. So the balance now is $4,000. So $5,000 debit minus $1,000 credit that you just gave this customer. And now the balance of your allowance account is 2,240 minus 1,000. So $1,240 is your new balance. Okay. Now this customer sent a check on March 2nd. The customer sent the check for the remaining balance. Okay. So you received check, which you can also treat as cash, because the minute you go and deposit in the bank, okay, within a day or two, you get that money. Okay. So your cash account went up. How much? $4,000. 5,000 minus 1,000. That's the balance which the customer is ready to pay. So $4,000 debit cash. You will see in your cash account, you will see that now you can see a balance of $4,000 on the debit side. And why debit side? Is because cash is your asset and assets are increased on the debit side. At the same time, you have to credit the accounts receivables account. Why? It's because now this person does not owe you any money. Okay. They owed you $5,000 from before. $1,000 you agreed. You said, okay, you don't want to pay. I don't have any backup for now. Okay. Whatever backup we had, we sent you already. We don't, for some reasons, we lost the record or whatever that problem was. It's okay. You don't want to pay $1,000. At least pay us the $4,000. And you agreed that you will write off that amount. Okay. So the balance was $4,000. So now you got the check. Now you have to close this account. You have to close this account because now this customer does not owe you anything. So you put a $4,000 credit And now the new balance of this account is $0. Now let's see what happens next. Well, you are lucky. On 22nd of March, this customer called and told you, hey, listen, I found the backup. I will be able to pay you the $1,000 that I was not able to before, because now I have the backup. I agree, I have to pay you the money. Obviously, in a business to business relationship, nobody wants to spoil a relationship, right? So they will also try their best, okay, to be as reasonable as possible. Okay, so in this was a really, really good case. You got lucky. Now you are going to get paid your $1,000 balance. So what do? The first thing you need to do is you need to put this $1,000 back into the accounts receivable. You will put this back into the accounts receivable. So $1,000 debit. And the provision or the allowance that you had used, you have to put that back too, because now you don't need that allowance anymore. You can use that allowance for a different customer. So you will put the $1,000 back into your allowance account, and you will see that now your balance is again back to where it started. Okay, so your new balance is the same as before. Okay, you had started with 2240, and now you can see your balance back is 2240 because this customer ended up paying everything, and that confirms. Remember what I said? This is just an estimate. Could happen, could not happen. We don't care. We have to be ready. Okay, so now what is the new balance of this customer? It's $1,000. Okay, and what's going to happen now? The customer will send you a check. The customer is going to send you a check at a different time. Okay, so sorry, so on March, so this is March 22nd. Okay, and the customer is going to send you a check. Let us say they send you a check on the 25th of March. They will send you a check on 25th of March. And what are you going to do? That check you will take to the bank, and you will debit your cash account for $1,000. Okay, you will debit your cash account for $1,000. So now you have cash of $5,000. Okay, you can see, so for $4,000 you collected before, $1,000 you collected now. That is your new balance, $5,000. Okay, and at the same time you will credit your accounts receivables, because now your balance is $1,000. You have to zero this balance out because this customer has sent you the check. Okay, so what you will do is you will credit your accounts receivable $1,000, and you will see this credit entry going here, and your new balance becomes 0. So what this customer has done is has paid you the entire balance of $5,000. Okay, you collected check 2 times. First check was $4,000. The next check was $1,000. You collected the entire balance, and you did not use anything from your allowance account because there was no need to use, because you got paid. Now, maybe a different customer is going to call you, okay, say, well, oh, I cannot pay you $500 or I cannot pay you $1,000, so whatever that is, right? And you will follow the exact same procedure. So this was just an example. Okay, I made some transactions here about, okay, how you open an account receivable. Okay, when you sell something or provide service, they don't pay you cash. They will pay you at a later date. You open your account receivable account. Then you estimate your bad debts in that same period. Okay, in the same period, you have to estimate and report, because remember, when you have revenue, there are expenses and costs too. So if you're reporting a revenue in the month of January, the cost and the expenses must also be reported in the month of January. And we will focus more on these particular points in our next presentation. Okay, this was an example. So this customer had told you, I'm not going to pay you $1,000. Okay, so you made some adjustments. We learned how to calculate our net realizable value, which is basically your accounts receivable balance minus your allowance for doubtful account balance. We learned how to do that. We learned different journal entries. Okay, how to report your allowance, how to report if somebody is definitely not paying you. So what do you do in that case? Okay, and this particular example was that. Okay, you use the balance of the allowance account and reduce the balance of your accounts receivables. And then when you get a check, what do you do with the check? Okay, that is debit on cash side and credit on accounts receivable side. And then we also learned um, the customer call you back, and now you got to put the balance back into your accounts receivables. What do you do that? You again debit your account receivable and credit your allowance account. Okay, and then obviously the last part was the customer paying you the remaining balance of $1,000. Okay, so this was just an exercise. Okay, we will get time to do more questions. Okay, when I get time, I'm gonna, we will solve some more questions together at a later date. Um, in this presentation, that was basically it. Okay, let's see what is in part of our next presentation. Okay, in the next presentation, we will talk about accrual accounting. Okay, so accrual accounting, cash accounting. So we will have the difference between those two accountings. We will learn how to do adjusting journal entries. And then part of that video, okay, part of the video will be about closing journal entries. Thank you for watching. In the comment section below, please let me know your thoughts about the content and what other topics you would like me to explain to make learning easy for you. Finally, please do not forget to hit the like, subscribe, and the bell icons to get the latest notifications of our videos. See you soon in the next class. Till then, take care.